Do you have kids? And do you want to make sure that they are set up financially for life? My name's Devin Burr. This is my daughter, Brooklyn. In this video today, I'm going to show you exactly how I'm setting her up for life by giving her a foundational asset that she can use for the rest of her life. You're good at this, baby. Let's jump into it so you guys can see how this works.
So this is the foundation of my house. It's about 6 to 8 inches thick, and that's all that's needed to support the weight of the house. It's a normal size house, about 3,000 square foot, and it's a 2-story home. The bigger the structure, the bigger the foundation has to be. So for a skyscraper, it's got to be about 6 to 20 feet in thickness for the foundation. So how does this relate to money and a foundational asset?
Financially, I want my daughter to be set. I want her to have the skyscraper financially. I don't want her to just have a house. I want her to have a ton of financial freedom. And the way that happens is me building the foundation for her. Again, a foundation is what goes first. So when you're building a house, you pour the foundation. It's only got to be about 6 to 8 inches in thickness. Now you build the house and the foundation can hold the house. If you have that same foundation on a skyscraper, the skyscraper will collapse. The skyscraper needs 6 to 20 feet of a foundation because it's holding so much more weight. So it's the same thing financially. You gotta build a really, really strong financial foundation if you're gonna have a bunch of assets and a bunch of things going on later in life. And that's what I'm doing for my daughter. I'm helping her build a really strong foundation. If it was just, she's going to have the house financially in her life, she wouldn't need that much of a foundation. I could maybe throw a little bit of money in a savings account for her. Maybe when she's starting to work, start a 401k for her, all those normal things that people do for their kids. But what I've done is I've built a specifically designed whole life insurance policy. Now I've got it behind me. I'm going to show you guys everything. But before you say, this is stupid, this is a snake oil salesman, guys, try to understand what this is. It's a foundational asset. It's not an investment. It's not something that you're going to do in lieu of buying real estate. It's not something you're going to do in lieu of buying crypto or putting money in the stock market. It is a foundational asset, meaning it's where your money goes first, not where it goes indefinitely. So this is how it works, guys. With these kind of policies, when you put premiums in, when you pay your premiums, the bulk of the premium goes towards cash value. So that's money you can use for whatever you want throughout life without interrupting the growth of the foundational asset. With life insurance, it's guaranteed to grow. It's guaranteed. It'll never stop growing. With this policy, it'll never, ever, contractually guaranteed, never grow less than 3.25% tax-free. So it's kind of like if it was making 5 or 6% before taxes. So this is tax-free. Plus it gets a dividend every single year the insurance company is profitable. This company here, they've been profitable every single year for like 145 years. So the dividends, they're not guaranteed, but if they've paid them every year for 145 years, they're pretty much a sure thing. So it's a foundational asset that's guaranteed to grow. It'll never stop growing. Most of the money that's put in is going right towards cash value. So you can use that cash value for whatever you want without interrupting the guaranteed growth, the dividends. It's tax-free and it's protected against lawsuits and judgments. So nobody can take this money. This is the safest place for money to go for my daughter because it's untouchable. Nobody can touch it. It doesn't get taxed, and it never loses its value. It only goes up in value, guaranteed. So here's how it works. With my daughter, you can start a policy and own it. So I own this policy. I should say my trust owns the policy, but I control the trust. So essentially, I own the policy, I control it. Now, the policy is on her life. So, God forbid my daughter passes away, I would get or my trust, I should say, would get a death benefit payout of $550,000 if she was to pass away this year. God forbid that happens. Every single year, that death benefit goes up, and I'll explain why in a minute. Now, what I can do as the owner of the policy, when I fund it, when I put money in it, all that money is guaranteed to grow and compound, like I was telling you, tax free. Most of it is going towards cash value. So I can use that money for whatever I want to go buy more assets. I designed it to put in up to $10,000 per year without being taxed. If I start putting in more, it'll be taxed. That's called the MEC 7 pay rule. And basically, the IRS says you can't put too much money into a life insurance policy because then it's not really a life insurance policy anymore. They'll tax you as if it's an investment. You don't want that. So our team, we know how to structure it to where it never becomes taxable. It never crosses the MEC line. MEC. That stands for Modified Endowment Contract. So $10,000 a year I put in. This is year 2. So I just funded year 2. We got this policy when she was 2 weeks old. You can get a policy on somebody when they have a social security number, and you have to have a insurable interest in them. My daughter, I want her to live a long time. That is an insurable interest. I've got policies on my wife. I've got policies on my in-laws, on my parents. I want all those people to live a long time. So I can own these policies. They're the insured body. So as I put this money into her policy, I instantly, in the first 30 days, have access to the cash value. So here's how this shakes out. This year I put in 10,000 bucks. And as you guys can see over here, the cash value is 11,278 bucks. So I've put in 20 grand and I've got access to a little more than 50%. That was by design. I could have designed this to have more liquidity early, but what that does is it slows down the long-term growth. My daughter was 2 weeks old. She's going to live a long, long time. I want the long-term growth to be really, really good for her. Again, this is for her. This is building her foundation for finances in the future. This is just one policy. I'm going to get several on her throughout her life. But you have to understand that on a kid, you don't want it to be super, super liquid because then it's going to grow really slow in the long run. And they've got a long runway for money to grow. I'll explain how that works here in a minute. So 10,000 goes in. As you guys can see, I've got access to about 11,000 in this year. I put in 10,000 next year. That's the premium dollars. And the cash value will go up to just under 18,000. And then the next year, put in 10,000, cash value will go up, looks like a little over 9,000. So it's almost efficient at that point when she's 4 years old, meaning when I put money in, I've got access to as much as I just put in, and she's only 4. She's going to live a long time. So guys, this is the product. This is the product that gives me the foundation. But when it comes to finances, when it comes to wealth, it's all about the principles, what you do with the money. So I'm going to teach my daughter how to become her own bank. That's what I teach people how to do, is be their own bank in their life using this foundational asset because of all of the benefits, all of the creditor protection, the guaranteed growth plus dividends that's tax-free, and the legacy piece that goes up every single year. So I'm going to show you guys how I'm going to teach her how to use this concept, how to use the principles to become wealthier and wealthier and wealthier over time. First though, real quick, I'm going to explain to you guys why the death benefit goes up, and it continues to go up her entire life. So think of it this way, guys. There's 2 parts to a policy. There's a base premium. That's regular, off-the-shelf, whole life insurance. That's getting you a big old death benefit. but very, very little cash value early. It takes several years for base to start creating cash value. And then there's PUAs, paid up additions. This gets you a little bit of death benefit and a whole bunch of cash value. So what I'm doing with these policies is I'm lowering the base, I'm lowering the death benefit, lowering the commissions, and overfunding it with PUAs, paid up additions. So that gets all the cash value and a little bit of death benefit. And then every single year, when there's a dividend, I have that dividend purchase more paid up additions. What that means is I'm getting an ever increasing cash value. As you guys can see, the cash value is ever increasing. Because look at, here's a dividend, 1,900 bucks, bought more paid up additions. 2,300 bucks, bought more paid up additions. By year 10, 5,700 bucks, bought more paid up additions. I have an ever increasing cash value and an ever increasing death benefit. Because remember, the PUAs gets you a whole bunch of cash value, but a little bit of death benefit. That's why you see that the death benefit this year goes from 550, next year it's 578. Year after that, 607. By the time she is just, let's see, 34, that's the last year on this page, the death benefit's all the way up to $2.1 million. God forbid my daughter passes away at 34 years old. $2.1 million goes to our family trust. Now, that family trust has a succession plan, meaning it's something I wrote that says this is how money's going to be spent, even when I'm gone. So the succession plan states that when money comes to that trust from a death benefit, tax-free, it has to purchase more policies like this one that grow tax-free, that can be used tax-free, that have all the protection against lawsuits and judgments. Guys, this is what the Rockefeller family has done for generations. We all know the Rockefellers. John D. Rockefeller made a fortune back in the early 1900s. And that family has gotten wealthier and wealthier and wealthier because this is what they do. They use properly structured whole life with properly structured trusts. So that's a whole nother video for you guys, but let me show you exactly how I use this policy to teach my daughter how to build more. This is the foundation. So I'm building it really, really big and dense, really deep. I'm building the skyscraper foundation. I'm going to show her how to build the skyscraper. That's what I'm going to get into next here for you guys. Let's check it out. Now, before I show you guys how I'm going to teach my daughter how to use the foundational asset, I want to show you just how efficient this thing gets. It's really, really cool. When she's 18 years old, super young, still a kid at 18 years old. But when she's 18, this policy is getting super, super efficient. So $10,000 goes in the premium, like I was mentioning before. That's the premium that I can put in, 10 grand when she's 18. The cash value at 18 is 249,000 and some change, and it goes up to 271,000 and some change for putting in 10. So that's $22,654 in growth inside the policy for putting in 10 grand. Guys, that's 126% cash on cash return from the policy. That's just the product. That's just the foundational asset doing its thing in the background. That's not including everything you can do with the funds, which I'm going to get into on the next slide here. 10,000 goes in, so you got to take 10,000 away from the growth, which is left with $12,654. That's the net growth from the policy. Put in 10 and it grows by a net growth of $12,654. That is 126% cash on cash return for that 10,000 bucks. And it's because all of the money within the policy never stops compounding and growing, regardless if we use all of this cash value. So Let me show you guys when she's 18 how we would essentially use the policy. Okay, so let's say she wants to go to college. The average right now, this is not taking into account inflation, it'll probably be higher, but as of right now, the average 4-year out of state schooling cost, this is with tuition, room and board, all that. It's about 182,000 bucks. It'll be higher in 18 years, but as you guys can see on that last slide, she's got 271. So she'll have enough, and this is just one policy. So 182 grand is the average cost. The average interest rate is about 6 to 9% on a student loan. So what we're going to do is we're going to use her policy to pay for her schooling, if that's what she wants to do. So 182 grand, we're going to take a policy loan. So we're going to use the policy as collateral. The money in there, all the cash value, it was 271 grand at this point, is collateral to get a loan from the insurance company. That money will not be removed from the policy. It'll just sit there and compound and grow, guaranteed tax-free. So we're going to use it as collateral to borrow the insurance company's money. Big thing in real estate is OPM, other people's money. That's all we're doing. We're using our asset as collateral to get a loan from the insurance company. They're using the collateral, giving us a loan. That money's continuing to compound and grow. So we borrow against the policy, 182 grand. We pay for her college. Okay, so her schooling is paid for. Now, if she would have got a loan, it'd be 6 to 9% on a student loan. So if she would have had to pay a student loan 6 to 9%, wouldn't it make sense to pay herself that? So what I used, guys, is 7%. A 7% loan for 10 years on 182 grand is a payment of $2,113. So all we're going to do is we're going to be the bank, or we're going to use this cash value, get a loan from our policy, pay for the schooling, and then treat this money just like we would have treated the money from a bank. We're going to pay it back with an interest. 2,113 bucks is 7% over 10 years. That means all of this money, we're just going to pay it back into the policy. We're going to pay down this policy loan. Now, the cool thing about it is that means we're going to get all of the $182,000 back into the policy, where it's protected against lawsuits and judgments, where it's guaranteed to compound and grow tax-free. Not only that, we're going to get the interest that we would have otherwise paid to a bank. That's infinite banking. You're taking back the control of the money and making what the bank would make on you. So we're getting the 7% interest that's built into this payment. What that comes out to be, guys, over 10 years is $253,000 that we're getting into that policy. So we're getting all the money back, all the 182 grand, plus the interest. The interest is about what, $71,000. That's money that would have been gone forever paying back a student loan. 253,000 bucks would be gone forever, meaning it would never be able to compound and grow for our family for the rest of our lives. With this 182 grand that we're using is the insurance company's money. Our 182 is sitting in that policy, compounding and growing tax-free. So even though we're using it, essentially, we're using the insurance company's money, this is still compounding and growing at around 6%. That's with the guarantee and the dividend combined. So we're getting about a 6% growth, tax-free, while we use the money to pay for her college. And then we're treating our money just like the banks. We're paying it back with interest. When we pay back this 2,113 bucks, it goes back into a place that we control. Soon as this goes back into the policy on a loan repayment, we have access to it again. So if we need to use 2,113 bucks, it's sitting there ready to use. It's protected against lawsuits and judgments. It's in a place that's guaranteed to compound and grow tax-free. So all we're doing, guys, is we're building up the foundation, like I had mentioned. We're building up a foundation for my daughter to be able to use it throughout her life and never lose control of the money. That's the main thing. The more control you have, the less risk you have. If we get a regular student loan, 6 to 9% for 10 years, we're losing control of every single dollar that we pay. That money is gone. We'll never get it back, and we've lost control of it. With this, it's a closed loop system. You just got to build the foundation. And that's what I'm doing for my daughter. I'm building a big foundation for her. That way, when she's 18, she wants to go to school, she can pay for her schooling in a closed loop system where she never stops the compound growth. She gets back every dollar she used to pay for college and the interest she would have paid to a bank if she got a regular student loan. Not to mention all this money. So the difference here, right? That's about 71,000 bucks. That extra 71 grand is going into a place that's guaranteed to compound and grow tax free. That's protected against lawsuits and judgments. That's just one use of the policy. And it's just when she's 18. It gets better and better and better and better, guaranteed for the rest of her life. It's contractually guaranteed. So every single year, when we put in premium, it grows by more than it did the year before. That's because it's uninterrupted compounding interest. The compound interest is never interrupted. So you have to look at compound interest as something that it doesn't do a lot early on. As I mentioned, guys, I put in 20 grand into the policy so far. I've got access to 11. So there's a cost for the insurance, the death benefit. So that's why I don't have access to all of the funds. However, the growth at a certain point outweighs the cost. And that's what I was telling you guys about year 4 or so. When I put in 10 grand and I've got access to 10 grand, that's because the growth outweighs the cost. And every single year, that growth keeps getting bigger and bigger and bigger. And the cost, the death benefit cost, never changes. It stays exactly the same. Contractually, it never goes up. That's the beauty of whole life insurance. The cost of insurance never rises, but the growth never stops. So the longer you have the policy, the more efficient it gets, the better it gets, guaranteed. And if you use it for the concept of infinite banking, this is a strategy. The foundation is just the product. The product is a properly structured policy. If you just get a properly structured policy and you think you're going to become ridiculously wealthy from just getting that, you're sorely mistaken. It's how you use that product that makes it good. Think about it. If I can use this money and capture 7% interest that I would have given away and get that interest into a place that's gonna compound and grow guaranteed, I've just made this vehicle more efficient. I've gotten more into it. I'm building its foundation even bigger. Guys, this is something that I wish I knew a long time ago. I wish my parents knew this. I wish my parents did this for me when I was 2 weeks old. In fact, let's pull up the policy, this policy here, when my daughter is 40 years old. So when she's my age, just to show you guys, if my parents would have known this, if they would have done this exact same thing, how well off I would be right now. Let's check that out. Check this out, guys. This is on Brooklyn Burr. It's my daughter. Now, we got the policy, let's see, January 4th of 2024. She was born December 2nd of 2023. So as soon as she had a social, we got the policy enforced. As you can see, the dividend option, like I was telling you guys, is purchasing paid up additions. That's what grows the death benefit over time. Every time there's a dividend, it purchases more paid up additions. So when she's 40 years old, check this out. $10,000 goes into the policy. That's the premium that year, 10 grand. The cash value grows that year from $1,109,000 to $1,174,000. So, geez, guys, what's that a growth of? 63,000 bucks for putting in 10. So if my parents would have done this for me at 40 years old, I would put $10,000 into the policy because they could assign it to me. I can assign this to my daughter, Brooklyn, at some point when she's 18 years or older. So at some point, if I feel like she can do this on her own, she can do the concept, she doesn't need my help anymore, I can assign it to her, and now she owns it. She puts money in, she controls it. Right now, I control it, okay? So if my parents would have done this for me and they assigned it to me at 40 years old, which is what I am now as of the recording of this video, 10,000 bucks, I would put that into the policy. I would get a cash value growth of $63,000. I didn't have to do a thing. All I had to do was put 10 grand in. Now I can use that 63 to go make more money. I can put it into real estate. I could put it into crypto. I could put it into the stock market and buy dividend paying stocks. I could take those funds, that 63 grand in growth, and deploy it to make more growth. All I had to do is put in 10,000 bucks. Okay. So let's look at the growth on that, guys. That is insane. That'd be about a 53% or $53,000 net growth for putting in 10 grand. So that is a cash on cash return of 530% cash on cash for the 10,000 bucks. When my daughter Brooklyn is 40, my age, just for putting in 10 grand, she's going to get a cash on cash growth of 530%. And the next year, it's going to be even better. So 10 grand goes in when she's 41. Cash value goes from 1,100 and basically 75,000 to 1,243,000. So that's what, 25, that's $68,000 growth, which is a 580% cash on cash return. It just keeps getting better and better. Guys, this is amazing. I wish, again, my parents knew this stuff and they did this for me. I am setting my daughter up with an amazing foundation. Guys, this is something I wish my parents would have done for me. I'm doing it for my daughters. I urge you, if you have kids, you gotta set them up with something like this and make it to where you build them a foundation that they can stand on for life. If you want to do that, check out the description in this video. There is a training video. Watch that video, and at the end you can schedule a call so we can help you put together something like this for your kids, for yourself. It's something that, again, I wish my parents would have done for me. So check out that video in the description. Also, if you like this video, smash that like button. It's going to help me get out to more people and help more families really build foundational wealth. Now, if you liked this video, you're going to love that one. Until next time, I love all you guys. Peace.